Hey gang, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, where I try to teach you something about finance so you can use it to make or save money. Please be sure to subscribe. We will have many more videos to come, notifications if you want to get them right away. Check at the end of each lesson here about different websites and links. And then, of course, if you go to drfranksfinanceworld.com, we have a great bookstore there with the books that I suggest and the ones that I've liked reading based on these topic levels. So anyway, we've talked about a lot of stuff in the area of fundamental analysis. We've talked about where to find the data and how to pull it up and eventually how to transform it. The purpose of all this is to understand better about where they're going to be in a year or two or three from now and try to make predictions about that, because it's that combination of numbers and cash flows when we bring them back through time that will allow us to see what something is worth. So we're looking today, it helps to know about the products and that kind of stuff out there. It helps to know about their marketing positioning and all that kind of stuff, their financial capacity, what economic environment they're going to compete in out there. All of these thoughts about their products and competition and where they're going will lead you to making estimates about where they will be. And ultimately, in accounting sense, those are called proformas. So let's look at the next page at a specific tech company. So I just put in what at the time was the price per share. And the trends, the historical information is this right here. You see in bold the ones that are the estimates or projections. And I was looking at the revenue growth leading into it. It was quite a high growth company. You can see that it was indeed beginning to slow down. Their cost of revenue, if you remember from the accounting, it's the revenue minus cost gives you gross profit. You subtract the operating expenses or overhead, and that will give you the earnings before interest and taxes. Subtract out interest and taxes, and you'll have net income, add back in depreciation, and you'll have cash flow. So step one was figuring or financing or looking at the revenue growth out there. So I just sort of picked a number of 12%. So I'm going to take each and every one, we'll see this on the next page, I'm going to take their revenue for 2012 and I'm going to multiply it by 1.12 to grow it 12%. And then of that revenue, I'm going to take that revenue I calculated and 58% of it, 0.58 times that, will give me the cost of goods sold. 0.09 times that will give me the operating expenses and so forth, and I'll be able to create an income statement using historical numbers. You can see cost of goods sold was hanging out around 60% or so. 58 is the company that was picking up more service type products, which will drive down their cost of goods sold. Once again, knowing what makes up their numbers and their revenue and so forth can be very helpful in these numbers. Operating expenses had been hanging, they'd been as high as 11, but it cut back to about 9 or 10%. So I went with a higher cost of goods sold. These numbers out here are actually kind of a migration from where they were from 56 to 58 and then eventually 63. It's kind of a high number. It's kind of a negative number, if you will, but I wanted it to have to jump through hoops in order for me to actually want to consider or buy this company. Depreciation and of their assets had hung out around 2.1%, so we just kept that number the same, and then you looked at what their revenue and so forth was. Anyway, when you run those numbers on the next page, here, once again, was the actual revenue leading up to it. Over here, sorry, wrong one. Over here, the revenue, this was the revenue in 2012. This is the revenue that I grew 12% to get this number. And this number right here is 58% of that number. And it leaves you with a 42% gross profit margin. And then you have to subtract out the operating expenses to get EBIT or operating income, operating margin there and so forth. You can see that there are other expenses out there, and in the end you get down to a net income available to common shareholders of this, and based on the number of shares that they had out there, this is what their earnings per share was going to be. We're going to use the earnings per share times a future earnings per share multiple to get to something called discounted cash flow, and that's what's coming next. So anywho, so this is how I created what their projections were going to be for each of the 5 years going forward, because I'm going to use the cash flow from these years as well as the earnings in year 5 to develop a model called DCF that will give me some intrinsic value for the company out there, which is what fundamental analysis is all about. So to get all the numbers really ultimately to predict the balance sheet numbers and stuff it's great when you're trying to see where the company is going to be and you're looking at debt and cost of debt and some expenses in there. But the reality is it isn't needed depending on what type of analysis you do immediately, at least not for DCF, which is what we're doing next. So because the balance sheet is a bit more tricky, we use the percent of total assets, but we also use a couple of other metrics where we scale inventory, receivables, and payables by cost of goods sold or receivables, depending which number. And the idea here is if sales grew 10% and inventory grew 10%, you'd have the same number of days of inventory. Same thing with receivables and payables. It lets you see, like we were looking at those numbers before on that other firm, we saw the inventory building up. And what you would find is, if we made these calculations, that the days inventory was actually quite a bit higher. So it's another way of looking at it from a scaled version, a standardized method that we can see where there might or might not be problems. So to complete the next part of fundamental analysis, we need the income statement, not the balance sheet. I have a whole section coming up on more in depth about, in a later video, about how the accounting numbers and the finance numbers fit together. So the next step, of course, is to figure out DCF or use numbers for DCF. Closing up this section, though, I still love this book. This Eric Halford book is one of the best practitioner books I've ever gotten. If you go to drfranksfinanceworld.com and go to the book section, you can click on that. It'll take you directly there. There isn't a whole lot of research on creating proformas, to be honest with you. But from a strategy tip standpoint, use logic and trends to make your best guess. One of the things when we get deeper into firm valuation, into the accounting connection and so forth, is some of the numbers are difficult to predict. You don't know what they're going to do next year, and there's some strategies for that as well. But it doesn't have to be perfect, but it also shows you why, or at least you'll see then, when you make your predictions, why they might be different from somebody else. Somebody else might have a different revenue growth rate, or a different cost of goods, or a different expectation for operating expenses and so forth out there. So don't forget to send emails with comments, please. Ask Dr. Frank is coming up, and DCF is next, which is an important part of the valuation process. That's it. Have a great day. Appreciate you. This is a short one. Bye-bye.